My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Apple and Tesla led the market today. Dow gaining 146 points, S&P advancing 0.32%, Nasdaq climbing 0.35%. The averages, frankly, they were almost a sideshow to these two stocks, and each had a very different story to tell. Both incredibly instructive about what can make a stock go higher in this dynamic market. Now, you wouldn't expect the overall market to be this benign coming into the biggest earnings week of the year, with a worrisome Fed meeting, worrisome labor report at the end of the week. But the trajectory of these two stocks, both incredibly weak for the year, has nothing to do with the Fed or the employment report anyway. So how did Apple stock rally 2.5%? Tesla stock roar 15%. What happened? Right, I've been saying that Tesla stock would keep going down unless and until Elon Musk pulled a rabbit out of a hat. He wasn't able to find that rabbit in time for the quarter, but he bagged a terrific one this weekend when he got permission to sell a subscription-based derivative of full self-driving for the Tesla in China, which gives him a whole new revenue stream, a big one. That can go a long way to restore price momentum after vicious price cutting in China. Just as important as how Musk got it. He made a surprise trip to China, met with Premier Li, and nailed down a deal with Baidu, the Google of China, that allows us to have the best maps available. This is unbelievable. And it's also a perfect example of a CEO redefining the narrative. There have been a feeling that Musk had gotten so, I don't know, they had so much going on that he hadn't been paying attention to Tesla. Now, here he is doing something no American CEO can do. Just get on a plane and make a deal with a leader of a country that our government isn't particularly fond of. I can't think of anything similar in the annals of American business, except maybe when Arm & Hammer went to the Soviet Union during the Russian Civil War and became Lenin's chosen capitalist. At the time, there were U.S. troops in Russia fighting against the communists, and this guy still made a fortune negotiating with Lenin. Of course, I don't put Xi Jinping in the same category as Lenin, but he's still much more, he's a little more friendly. Ha! But Hammer's the only other executive I can remember who could make a surprise trip to a hostile country and come back with an extremely lucrative deal. That said, it's not a magical elixir for Tesla. It's not full self-driving. Competition remains stiff. But let's face it, no one else can pull this off, which is why shareholders love the guy and bid the stock up so much, making fools of last week's downgraders. It's almost as if that Musk had leverage over the regime. Hey, maybe he does. Maybe they're just as dazzled by him as everyone else. Either way, it's made people a lot of money. Will Tesla the move have staying power? Look, plenty of people shorted the stock, betting that they could finally break the darn thing. They failed. The stock can keep running until the shorts are all crushed. All right, different story, Apple. Now, I'm not a fan of what went in today's rally. See, today, Tony Sacconaghi from Bernstein, famous analyst, on TV a lot, upgraded Apple to a buy with a piece called Buy the Fear, Upgrading to Outperform. Apple is derated significantly, says, amid a weak iPhone cycle and fears that Apple's China business is structurally impaired. Sacconaghi believes that the expectations have finally gotten so low that it can work. Stocks underperformed the S&P by 19% year to date. On top of that, he points out, quote, Apple is entering a seasonably strong trading period. The stock has outperformed in the 3 months leading into the iPhone launch in 15 of the last 17 years by an average of 1,280 basis points, end quote. That is huge. And he doesn't believe the China problem is existential. He thinks it's normal cyclicality. Now, Sacconaghi believes that because the stock's less expensive than it's been, it's now worth buying. You know what he's doing? He's urging investors to be like Buffett, whose well-attended annual meeting is coming up Saturday. As Tony says, quote, despite his reputation as a long-term buy-and-hold investor, Warren Buffett has been remarkably disciplined about adding to his Apple position when it is relatively cheap and trimming it when it's relatively expensive, end quote. Even as this quarter likely won't be good and the guidance will be weak, Tony believes Apple can sustain 4 to 5% revenue growth, and that could translate to 8 to 10% earnings growth. Everyone who watches this show knows one thing. I believe in owning, not trading Apple. It's been my view for at least 20 years now. But Tony's an Apple skeptic. Get this. In February of 2018, he downgraded the stock because he thought Apple's growth would slow dramatically thanks to weak iPhone sales. He also cut his price target from $195 to $170. Now, I know. You might think that's not that bad, given that Apple's now at $173. But au contraire, there's just one problem. Since Tony's 2018 downgrade, the stock's had a 4-for-1 split. If you adjust the split, Tony downgraded Apple at $40.03. In retrospect, that was not a Buffett-like call. Now, anyone can spoof any analyst bringing up this stuff. You can spoof me, too, and people do all the time if you go over every pick. No one in this industry is right all the time. Nobody even comes close, including Tony. Tony Sagnet is a very smart guy, so I'm not trying to put him down. The bigger issue is that I think of him as the leader of the Apple's best days are behind it contingent. The one that has always the most critical questions, negative questions, one who's arguably done the most work, frankly, to keep you out of the stock, but it's really in a de facto sort of way. I think he's playing this thing, he's playing the whole negativity brilliant. Never really attacking thing, never really attacking Tim. Always, that's Tim Cook, the CEO, always damning it with what I call faint praise, never blasting Apple, yet being incredibly effective at making you dislike the company's shares. Even worse, Tony's a genuinely great analyst. His work on earnings is among the best. He knows numbers like no other. He may be the best there is in that department, the GOAT of estimates. If we were talking about any other stock, too, I got to take him pretty seriously. But when it comes to picking Apple's stock price and where it's going, his direction work is suboptimal. And for shareholders, the direction of the stock is more important than the sales and earnings. Or as I might have said in a more fiery moment of the old days, quote, the direction is all that matters. And he's gotten that wrong non-wasted Sunday. And now, here's what I am most worried about. It's natural to be a little superstitious here. If this guy downgraded Apple from $40 and he missed the move from 40 to 175, I actually don't care what his numbers are. I don't care about his iPhone estimates or his service revenue projections. I just know that if this guy, when he finally climbs on the bandwagon, it's now, well, it feels a bit suspect. If someone who got the price wrong for 6 years is now all over it, it makes me worry that there is, alas, some sort of jinx. Unlike Tony, I want you to own Apple, not trade it, even as I suspect this quarter will be weak and the next quarter will be worse. But I am with him that you should buy the stock. I just think you need to wait it out, because now you got a sagging negative spike on top of what could be a bad quarter. That's not what I want as someone who owns the stock for the Charitable Trust. I wish he'd waited. Here's the bottom line. Today, Tesla rallied to some genuinely transformational news brought to you by the incredible leadership of Elon Musk. But Apple rallied on an upgrade from an analyst who historically does not have a great understanding of this particular stock. That's a much less inspiring kind of rally with no staying power to speak of. Carrie in New Mexico, Carrie.
Hey, Jim. Booyah, Jim Cramer.
Booyah, Carrie.
Long-time listener, second-time caller.
Excellent.
Thank you for all you do.
Thank you.
I'm just want to know what your take is on Morgan Stanley as an investment.
We own Morgan Stanley for the trust. I wish it had been up more. Goldman Sachs is doing, my alma mater is doing better than Morgan Stanley. I liked the last quarter, but the stock seems to have stalled out again. It's very, very inexpensive, so I'm not going to trade it. I just wish I had bought Goldman. Jeremy in California. Jeremy.
Jimmy Chill, first time, long time. Booyah.
Glad to have you on the show. What's going on?
The guys in the Mad Money group chat and I, which is just a text thread that you've inspired us to talk all things stocks on. We're increasingly leaning towards Google reviews over Yelp. And given Google's dominance in search, do you think Yelp has a realistic chance at competing with Google in the long run?
You know, it can. It has a niche. And I've got to tell you, it's been around forever. I'm surprised someone hasn't picked it off. I guess they like to be independent. But it's down 13%, and I don't think it's, look, it's hard for me to say no, don't own it, because the next thing you know, Stopman might just say, I'm going to sell the thing, and then it makes me look bad. So I'm just going to say I don't really like it. How's that? Let's go to Keith in my home state of Pennsylvania. Keith.
Hey, Mr. Cramer, how you doing?
I'm doing well. How about you?
Oh, I'm doing wonderful. Hey, I got to say thank you to you and your team. You guys and your advice have helped us pay off the mortgage on our house, and we love you guys for it because we listen to your advice and we really take it to heart. So I have a stock I'd like to talk to you about.
Sure,
here and
thank
get
you.
your input
Thank
on
you.
it.
Sure. Well, how can I help?
So I have a question on Shopify. It's been really lagging since March, and I just want to know, going into earnings, if now is a good time to get in since it's really low, or what your opinion is on that.
I know it's down 7% for the year. I would buy a little before and a little after. I mean, you have to May 8th to make the move, but I think Shopify is doing incredibly well. It's had a big run. I think it can continue, and I like the company very much. All right, today brought us two very different kinds of rallies. Tesla, some genuinely transformational news, and Apple, an upgrade from an analyst who has not nailed the stock before. Look at the way I put that, huh? That kind of rally is unfortunately they're very not inspiring. On Mad Money tonight, as I said last week, with earnings rolling on, we're starting to see some brown shoots in this economy that you can't ignore. So where should you go to get a broader read on where we stand? Look no further than the rails. I'm seeing what the Big Four are telling us about the strength of our economy. and the country as a whole. Then, in a market like this, I'm always trying to find some under-the-radar stories that could be a winner for your portfolio. Tonight, I am unveiling an industrial conglomerate that's been quietly creeping higher that I really like. And ResMed stock was initially beaten down by the success of GLP-1s. So are the drugs a tailwind or a headwind for the company? I'm getting the latest from the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.